welcome back to another episode of the ICIS Energy Foresight podcast. Today with me I have Matt and Andreas. They helped me guide you through a piece of work which we've just published, which is called Temperatures versus Wind Speed. It's a white paper that tries to quantify the weather risk to the European gas and power market for the forthcoming winter. Hi guys.
Hey, Matteo.
Hi there.
So we recently published, and it's available in the footnotes, and obviously you can always reach out. This white paper, it's an analysis that shows how different weather scenarios play a different role across gas and power in Europe this winter. And we've built 8 different scenarios that try to simulate the impact of more or less severe winter, and understand how gas and power prices across Europe will react to the different scenarios and different situations. Andreas, I think I would probably start from gas, which is still probably the hot topic at the moment in terms of a lot of announcements, a lot of projections, and a lot of expectations around the forthcoming winter. Obviously, taking aside geopolitics, we are already in the winter, if you want, because the gas year has already started. Can you help us understand how tight is the market? How tight is the European gas market right now?
So first of all, gas prices in Europe have really come down from the start of this year to nowadays, just slightly above 30 euros per megawatt hour. So we are relatively low in terms of prices compared to the beginning of the year. You could say the market has relaxed over the year. And it's true to some extent. Concerns about gas storage have dissipated over the course of the year. We are now in a relatively comfortable situation on gas storage. Nevertheless, there is some tightness in the market, stemming mostly from LNG markets. So the global LNG market, which is growing to some 430 million tons this year, it's still slightly undersupplied in our forecast for this year. That means there is some level of tightness, which is particularly strong during the winter period. So we are looking at the winter, which remains tight.
So there is an expectation of oversupply looming, but effectively we're not there yet. So there is still tightness, and the market, especially if we look at Europe, there is an aspect which is obviously linked to infrastructures and the logistics of it, and there is competition, as you say, between different sides of the LNG market in the world, right? Like Europe versus Asia. So we see that depending on different weather scenarios, there is an asymmetric response to this tightness. Where do we see the asymmetry on the gas side? Is it like more like temperature related? Is it wind speed, like less renewables playing a role? Is it more temperature global? Can you help us understand a bit more, Andreas?
Yeah, from a gas market perspective, the most interesting scenarios to look at is the weather variations, because that's providing a huge swing to gas demand. We can easily see variations of 15 BCM in our scenarios between a very cold and a very mild winter. And that has repercussions for the global LNG market, with a general annual balance which is slightly undersupplied, but it's particularly severe over the winter months. From December and February, those are the months when the northern hemisphere is in winter conditions. So both Asia and Europe are competing for scarce LNG, and that implies during those tight months, any cold winter scenario has an asymmetrically strong response on prices. So the upside risk for gas prices in Europe is way stronger on the cold winter side compared to a mild winter side. So we are estimating an impact of around 10 euros per megawatt hour for a very cold scenario, whilst the downside potential is more towards 5 to 6 euros in a very mild scenario in our scenarios for Europe.
That is pretty interesting indeed. And Matt, this 16, 15, 16 delta that we see in terms of asymmetric response on the gas price, I'm sure that has a massive impact on the power side, especially in across those market zones where gas is still setting the price the majority of the time. Am I correct in assuming that?
Yeah, you're certainly correct in assuming that. So you get the impact that's coming just from the higher demand or lower demand within the power sector itself in terms of shifting the merit order. But as you say, gas plants are setting the price in most hours in most European markets over the winter. So what happens to the gas price in those scenarios is actually more important as a variable compared to the changes that come simply from shifting the demand. So we see prices going up by as much as 13 euros per megawatt hour for Germany in the power market this winter in the event of extremely cold weather.
That is super interesting, and I think that there is a clue in your answer in terms of the delta that we can see, which leads me to the next question. So, indirectly, we are saying that temperatures are more impactful than wind speed also for power. Is that the case? And if that's the case, what's the difference in terms of possible price spikes or volatility overall?
Sure, yeah. Now, I think the wind speeds are very interesting to look at. We're talking about wind providing almost a quarter of European power supply over the winter periods, now that capacity has expanded to such a great level. So previously, you just had to look at temperatures. Now you really do have to look at wind speeds as well. And if you look at just the direct impact that wind speeds have on shifting the merit order, it's actually larger than the impact of temperatures. The price impact is only not as large because it's not moving gas prices by very much when you shift wind speeds, whereas when you change the temperatures, that has a very large impact on the gas price. And it's likewise true with price spikes. So again, because you're increasing the gas price as it gets cold, we see a lot more price spikes in most European markets this winter in scenarios where they're very cold compared to ones where there's not a lot of wind.
And I guess that's the advantage of having integrated models, that we are able to capture these feedback loops between gas and power markets and clearly understand where the asymmetry is, which might be intuitive or counterintuitive depending on the moments of the year or the market dynamics. Guys, I have a closing question. We did record a webinar for our customers a few weeks ago where one of the most interesting things, according to our customers, was the risk metrics. So the metrics of different risks and how different asymmetries are playing across gas and power. If I were to ask you what's the biggest risk for each market, and we start from gas, Andreas, what's the biggest risk for this winter for the gas market?
Yeah, so besides the obvious geopolitical risks that are around there, I would look at Asia, really. So we should all watch out for Asia. The demand variations we see from that region can be so strong, it dwarfs any other developments. So looking at the data, and we did that in our webinar, looking at the demand variation we see in extreme winter conditions for Europe, they are roughly comparable to what we see in China and other countries, Korea, Japan, from those regions in previous years. So the variation we see from Asian demand in terms of LNG can be so strong that it easily shadows anything happening in Europe.
Yeah, the global competition for LNG, which is becoming super interesting topic. And Matt, on the power side, what's the biggest risk?
Sure. Outside of the weather risk that we already talked about, I'd say that carbon prices are probably the key thing to watch. We know that the EU ETS goes very tight from 2026 and into 2027, where You have a lot of supply cuts in the market, and the demand side can't keep up with that. And that should add a lot of bullish pressure to carbon prices. We've seen in the last couple of months that carbon prices have gone up by about 10 euros per tonne. And we think that there's further to go. And that's not really being factored into power forward markets at the moment. So particularly when we get into Q1, we think there could be some bullishness on carbon prices, which would therefore have an impact on pushing up power prices next year.
Thank you both again. I think we've covered a lot of what's in the white paper. Again, if you guys want to have access to that, just please reach out directly to us, or obviously just log into our ics.com website. That's all for this episode of Energy Foresight. And thanks again, guys, and to the next time.
Thanks, Matteo.
Thanks. Bye.